Here we are. Hello, Bonnie. How are you today?
Hi, I'm great. How are you?
I'm doing well, thank you. We're speaking now with Bonnie-Lyn Bartok. She is the founder and CEO of the S Factor. Bonnie is a subject matter expert in social risk and performance, as well as impact measurement and management. In the last 25 years, she has worked across 60 countries in this capacity, advising governments, investors, corporates, and NGOs. She's won several entrepreneurial and technology awards, including first place in the UBS Future of Finance Award, named one of the global top 10 female fintech founders, won a seat in the Mass Challenge FinTech cohort, first place in ESG Advocate of the Year by the Private Asset Management Awards, and that's just to name a few. Bonnie's views have been published in numerous white papers, but also on BNN, Bloomberg, Globe and Mail, Morningstar, Wealth Professionals, TEDx, Investment Week, Alternatives Watch, Benefits Canada, and so on. She's led the creation of two firms, McCormack Inc. and the S Factor, and the creation of several proprietary products, including the world's first social performance index, the MSPI, in 2010, and the S Factor's social risk ratings and investment solutions in 2016. Now, Bonnie, when you created your first index, which correlated the social management of companies and superior financial outcomes, that was released in 2010. It was then known as the McCormick Social Performance Index, and copies of it are still available. For anyone who's interested in receiving those, they can go to the sfactor.co. The effort there was to capture quality and quantity of social performance. More recent enhancements have complemented that by incorporating big data, machine learning, and AI that have allowed the S Factor to grow, and monitoring and evaluation to become real time. Let's start there, Bonnie, with some comments on that statement before we move into the slides.
The statement about the evolution of the social performance index.
Yes.
So pre-CSR, pre-ESG, I've been monitoring risk and impact for a very long time, decades. The criteria from which we measure and how we measure has actually been around a really long time. So whilst there is a polarization of opinions and sentiment about ESG and impact, and looking for the standardization in some of these frameworks, it's actually been here the whole time. Nobody's applied it. And so that's what we've done, and we've applied it to the measurement. So rather than requesting that companies disclose and reply to specific criteria through survey data and what have you, we've gone out and tracked material evidence to benchmark it ourselves. And we've done that for decades now. And so we've compiled quite a bit of data, which I'd like to introduce you to today. So how we started was first to create, and I heard a lot about this morning, an incentive from which to sell our services. So if you do this, it will increase, performance. If you do this, whether we're speaking to corporates or investors, saying that there is a benefit to compliance in these areas against this data, and here's the proof. And so, 10 years ago, or 2010, we were a little bit ahead of the market. We still are. On the social sphere of things, we're talking about reducing greenhouse emissions. We're talking about electric vehicles, but if you're doing that with slave labor, who cares? Right? So that was the purpose behind this, was there's more to the risk factors. There's more to, the S isn't being considered, and nobody knows what S is, but S has been around for a really long time. And so we wanted to demonstrate the value of incorporating that. And we've now created a system in a series that is empirical in its evidence to show value for performance in these areas. So I've just given you my whole speech and we haven't even started yet, but I would like to, I can't see anybody, so it's really funny talking to myself on the screen, but I would like to, Paul, if you're up for it, to change slides. I'm going to go really quickly through a few. I'll let you know. The first 5 or 6 go quickly. So if you're up for it, I'll just start if that's okay.
Sure, yes, right away.
Yeah. Okay. So we are now the social factor data company. We provide social risk ratings and investment solutions to help investors navigate social risk. Next slide. As you've heard, we've won dozens and dozens of awards in the last 10 years. So we are on the radar. We just haven't made it over the finish line just yet. Some reaching as far back as 2010 for the first iteration of correlating social management and superior financial returns. Next slide. I think it's imperative to continue to clarify what we mean when we say ESG and SRI. Even this morning in our presentations, through every publication I read, we have overlapping language around whether we are ESG, impact, or sustainable investing. So just to clarify what we mean when we say ESG and where we sit on the spectrum, ESG, or environmental, social, and governance-based investments, often focus on material financial risks that affect companies. And I think we heard that echoed in Nikita's presentation this morning. So I'm very much in line with her sentiments about what ESG is. Whereas sustainable investing focuses on how investments can improve the world. So we've heard from, just now, impact investing was very much in the vein of sustainable investing as well. Two different strategies, but certainly focused on how investments can improve the world versus a material financial risk screening. Social risk in ESG is where S-Factor sits. Next slide. So our data that we compiled over the last decade sits at the intersection of big data and regulation for social factors. So we are focused on a very niche deep dive on labor, performance, supply chain, health and safety, communities, modern slavery, indigenous rights, ethics, diversity, and so on. But beyond governance, into the monitoring and evaluating of outcomes and impacts on a daily basis of companies' behaviors. Next slide. Our taxonomy, or the criteria from which that we are monitoring, focuses 100% on the impact of employees and communities where companies do business throughout the world and throughout their supply chain. Next slide. We monitor more than 1,100 more social risk indicators than the entire ESG screening industry globally. So very deep, very broad screening. Next slide. The criteria that we monitor on a daily basis comes from a plethora of codes, conventions, and regulations, that some of which have been around since the 60s, but also from policy and reporting frameworks, some of which have been ratified into hard law. So this is what's coming at us right now. You'll see through SFDR and SEC regulations, but also declarations of rights of indigenous peoples and modern slavery acts that are being ratified, not necessarily classified as ESG, but certainly in social factors of risk. Next slide. So after a decade of structuring raw data and structuring it in accordance to those rules and evaluating companies' performance outcomes and performance on a daily basis over a 10-year period, we've comprised a data set that is fact-based and material, but we've also now correlated it to quantitative outcomes and predictable outcomes of companies' performance based on social risk factors. So we are adding the real S to ESG here. In March of 2022, we released a report called Inside S-Factor, a greater source of alpha and a greater understanding of materiality. In that report, which you can download from my website at thesfactor.co on the analytics page, there are 4 studies. We partnered with external quantitative firms to help model our signals to quantitative outcomes. And we ran a series of tests. We looked at portfolios and ran regression tests and rebalanced them to see if we could achieve excess returns by rebalancing for the social signals that were there the whole time. We also looked at trading strategies, long only, long short, and high frequency hedging as well, based on outliers, events, and or trading at different frequencies like weekly, monthly, quarterly, and so on. but we also looked at annualized leaders and laggards indexes in order to achieve, to beat the benchmark, meet the benchmark, or beat the benchmarks of industry. And what we learned is that we always outperformed with these signals. We always had a signal. We're typically 1 to 3 months ahead of market in our signal over that 10-year spread. And we are always able to achieve excess returns. And now through machine learning and AI, we're able to develop predictability in our strategies with the enhancement of that technology. So we brought this product to market and it literally fell on deaf ears. Nobody knew what to do with it. It was too much data. 1,200 data points in real time across the entire public equities market and 40,000 funds was like a fire hose of social risk that nobody had seen before. And it's still ahead of the market. We're so focused on environment that we're not looking at the social risk aspects and tying it or pricing it in to material effects of companies. So what we've decided to do is go ahead and build our own suite of investment tools. And next slide, please. Today, I would like to introduce you for the first time to the Social Risk Index Series by S-Factor. The indices are designed to be broad-based trackers of leading companies based on aggregated and categorical social risk and performance scores. The indices are constructed using the top nth percentiles of companies ranked by social risk criteria, including and as well as an aggregated measure for for S-Factor's overall risk performance. The indices offer a targeted exposure to social risk and ESG using the deepest set of social risk performance data currently available on the market. The indices have shown superior risk-adjusted performance compared to similar benchmarks since their inception in 2017. Next slide, please. Full disclaimer, anything I'm about to tell you, you can't rely on. And everybody has to have a disclaimer slide. Next slide, please. Index construction. So the base universe for this index series is constructed from a universe of securities covered by S-Factor. We've evaluated over 42,500 companies in the last 10 years. We have a solid social risk profiles on about 14,000 of those companies on a 10-year history. The index constituents must present sufficient market capitalization and turnover in order to be included in the index. The index is rebalanced in this case on a monthly basis. For each rebalancing, the top 100 securities ranked by each category are selected for inclusion in each index respectively. Today, we're going to look at the top 100 US equities for diversity and inclusion, ethics, health and safety, human rights, labor rights, and supply chain. Index constituents are weighted equally. There's no free float adjustments or liquidity adjustments made in the weighting scheme. Index values for each point time of the index are obtained by multiplying price and weight dividing by the index divisor for each constituent in the index. Index values are calculated using real-time data for each updated constituent price over 1 second rolling window. Values are rounded to a maximum of 18 decimal points. Next slide, please. So we'll jump through these quickly. This is the overall performance on an 8-year spread. Our first top 100 US diversity for diversity and inclusion. We will be releasing these fact sheets this week, which will clarify what exactly is being measured and how we arrived at our scores, which companies are in this index. But on an 8-year spread, you can see that we've outperformed the SPY or SPIDER, which is the S&P 500 ETF coverage, and also the ACWI. So 59% over an 8-year spread, 100% over ACWI. Next slide, please. Our top 100 US ethics has outperformed S&P by 84.81% and the ACWI by 125% on the 8-year spread. Next slide, please. The top 100 for health and safety has outperformed the S&P by 28.53% and 98.0.1% over ACWI. Next slide, please. US 100 on human rights, top 100 on human rights has outperformed S&P by 75% and 160% over ACWI. And finally, next slide, please. On human rights, we have labor rights. The top US equities have outperformed S&P by 62% and over 100% over the ACWI in the 8-year spread. Next slide. And finally, our supply chain index outperformed S&P by 111% and 152% over ACWI. That's the year spread. Next slide. I want to look at, we have to look at some of the incrementals there, looking at annualized returns for 1, 3, and 5 years. And I have some notes written by some of our quants that are way smarter than I am on some of the analysis that we detected through this evaluation. So the US diversity, top 100 in diversity and inclusion. So as most global leaders would agree, diversity and inclusion in the workforce is important from perspectives of service to the community and avoiding groupthink traps. However, following 3 subpar years, this index has now underperformed recently the S&P since inception, ceding to its earlier gains relative to the benchmark. It's also underperformed during the last 1, 3, and 5 years. The ethics index, however, consisting of the most ethical companies as ranked by S-Factor, outperformed SPY and the S&P 500 ETF Trust since inception, a bit more than 8 years, for the last 1, 2, and 5 year periods. Since inception, that outperformance has been in excess of 200 basis points per annum. Its loss in the last 12 months was merely 2.6% compared with the loss of 6.9% in the S&P 500. The US Health and Safety Index, from date of inception until the advent of the pandemic in March 2020, the index performed very well. Once the percentage of work done in a physical workplace dropped dramatically, this index began underperforming S&P. The 3-year run was just 11.8% as compared with 14.4% for SPY. Now that the workforce dynamics have stabilized somewhat, its recent relative performance has improved to the point that its 7.1% loss for the past year was only marginally worse than the 6.9% loss posted by S&P 500. That said, the Health and Safety Index held into enough of its earlier gains to outperform the S&P by a slim margin for the most recent 5-year period of 9.1%. As compared.
Bonnie-Lyn, excuse me,
Yeah.
we want to leave a few minutes here for questions from the audience.
Yeah.
You shared an awful lot of data with us, and I'd like to know if there are any questions from the audience. Yes.
Sure. Do you want to jump to the last slide then, so I can make my point?
Sure. Go ahead.
I can't see anybody, so it's hard for me to read the room here, but not that one. Back. Okay, so conclusion. So what's my point? So what? Aside from the obvious upside of performance in these indexes, the ability to demonstrate superior value in these social factors can influence a change of behavior from both investors and companies, which would subsequently reduce negative impact and harm on society when focused on social risk. It's where risk meets impact. I give you the quantification of S in ESG. Thank you.
Thank you so much. I have a question based on the environmental justice component. We have seen a lot of overlap of environmental and climate justice coming up in different industries and local governments. Do you see a lot of the data that you analyze being used for those assessments, given that there are millions of dollars of funding available for those things?
Great question. So this is also where the divide between ESG diagnostics and impact sits. So, in the spectrum of environmental justice, we know what the inequalities are and who's affected the most by them. That diagnostic can be run through doing an ESG evaluation of the criteria. So we know what those numbers are. We know how many people and what the demographics are that are affected most by climate change. That is the strategy to change the outcome effectively is an impact strategy or sustainability strategy, whereby, we're looking to make the world a better place. But the diagnostic you would use, some of the issues that have created these scenarios come from the lack of accountability on, social accountability of companies' operations. So in some cases, companies' operations have actually led to some of these conditions around environmental justice and who's being affected. But we don't have social accountability on the internal diagnostics. We have, data to support societal need and where investment needs to be directed. But they are Band-Aid solutions unless we are actually running the diagnostic as to how we got there in the first place. They are
Okay. I think that's about, unless there's another very quick question, I think we're closing out this session. Bonnie-Lyn, thank you very much for all of your work putting together all of the data, and we really appreciate the presentation by Bonnie-Lyn de Bartok, founder of the S-Factor company, and all of the data. By the way, Bonnie-Lyn, these slides are going to be available to people who are attending today. Is that correct?
Absolutely. And even more than that, the indexes live live on Index One's site. We did this in partnership with a company called Index One to help us model them. So the fact sheets and more specific information and the live feeds for the indexes, I'll be publishing this week as well. You can
Great.
find them, but maybe
Okay.
follow me on LinkedIn.
If you will pass that information on to us here at the summit, we'd appreciate it.
Great. Thank you very much for the opportunity.
very
Great to
much.
meet you today. Thank you.